everyone, I'm JIMENEZ and I'll be discussing how to write a cash budget in a financial plan. At the end of this discussion, the audience will be able to know the components of a cash budget and how to come up with it for a financial plan. From the previous lecturer, she discussed that forecasting is described by process in which the entity think about and prepare for the future. And forecasting provides the means for that entity to express its goals and to ensure that they are internally consistent. It is normal for a business to have a plan, and that includes budgeting or making a cash budget. It allows the managers to achieve its organizational goals during a period of time. So what is a cash budget? It is an estimation of the cash inflows and outflows for a business over a specific period of time. It is used to assess whether the entity has sufficient amount of cash that is needed for day-to-day business operations. In creating a cash budget, it uses assumptions about necessary spending and collections, along with sales and collection forecasts. So why prepare a cash budget? It is used as planning tool for management decisions. A cash budget is significant for a variety of reasons. For one, it allows us to make management decisions regarding with the cash position of the business. In the year or a business cycle, a series of monthly or quarterly cash budget will show you just how much cash is coming into your entity and the way it is being used. Also, seasonal fluctuations will be made clear. There are steps for preparing a cash budget. The first one is to determine the beginning cash balance. You have to find out how much cash will be available for the beginning period. It is usually found in the statement of financial position from the previous year under the cash account. So the second step is to add the cash receipts. In this step, you have to calculate all the expected cash receipts, such as collections from customers, cash sales, and so on, which will flow into the cash account for each period. Collections may vary during a budget period. Fluctuations take effect depending on the season. For example, a retail store expects to receive most of their receipts during holiday seasons. So the third one is to deduct the cash disbursements. In this step, you have to calculate how much expected cash will be required to cover up disbursements or cash payouts. It includes payments for payroll, taxes, dues, and etc. The fourth one is to establish the ending cash balance. To compute for the ending cash balance, simply deduct the cash disbursement from the sum of beginning cash balance and the total cash receipts. For the last step, determine the financing needed. After determining if there is a cash excess or cash deficiency, this is when you will decide whether to finance the operation using the available cash or finance the period using other sources such as bank loans. In preparing for a cash budget, you have to consider the three main components. The first one is the time period. The first decision you have to make in preparing a cash budget is to decide which period the budgets will apply. The main question is are you preparing for a weekly, monthly, or quarterly, or yearly cash budget? The second one is the cash position. The amount of cash you wish to keep on hand depends on the nature of your business, predictability of the accounts receivable, and the probability of opportunities. Then the last one is the estimated sales and expenses. The fundamental concept of cash budget is estimating all the cash receipts and cash expenses. Categories included in expected cash receipts are cash sales, collection of accounts receivable, and other income, which includes investment, dividends, and borrowings. While on the other hand, expected cash disbursement includes payroll, inventories, advertising, administrative expenses, other expenses, which includes interest and tax payments. For the given example, we have here the cash budget for the year 2015 of Philippines Shell Corporation. As you can see, The time period used is by quarter. For the beginning cash balance for the first quarter amounting to 6.7 million, which came from the statement of financial position from the previous year, which is the year 2014. The estimated cash sales amounting to 13.4 million for the first quarter, 10.8 million for the second quarter, 12.4 million for the third quarter, and 15 million for the fourth quarter. Always remember that cash sales in all the categories are estimated amount depending on how the entity operates. Estimated cash disbursement, operating expenses for the first quarter amounting to 2.8 million, 2.4 million for the second quarter, 3 million for the third quarter, and 3.4 million for the fourth quarter. To get the cash balance ending, simply deduct the total cash disbursement, which is 6.2 million, from the sum of 17.8 million and 6.7 million, which results to 8.4 million, and so on and so forth. The ending cash balance will be the beginning cash balance for the next quarter. In a nutshell, cash budget is a primary tool for short-term financial planning that helps the manager to achieve their organizational goal for a specific period of time, in which it's an estimation of all the cash flows. Babe! In a nutshell, cash budget is a primary tool for short-term financial planning that helps all the managers to achieve their organizational goal for a specific period of time, in which it's an estimation of all the cash flows and use this information to access whether the company has sufficient amount of cash for day-to-day operations. It is always a note to remember that all the amounts are estimated depending on how the company operates and how it is affected by the seasonal fluctuations.